The stock market just hit its 23rd record high this year. Home prices are higher than they have ever been. Total net worth in America has never been larger. By every number that economists track, this is one of the wealthiest moments in the history of the country. And at the exact same time, consumer sentiment toward the economy has fallen to the lowest level ever recorded. Lower than the early 80s recession. Lower than the 2008 global financial crisis. Lower than the pandemic lockdowns. Both of those sentences are true. And the gap between them is not a data glitch or a media narrative. It is the most important economic story happening in America right now. And almost nobody is telling it honestly. You can see the disconnect most clearly by looking at the most boring account in America. The average 401k just hit a record high, crossing $160,000 for the first time. And in the same year, those retirement balances hit a record high. A record number of Americans were also raiding them early, willing to pay the 10% penalty just to get access to the cash. About 6% of savers withdrew from their retirement accounts last year, roughly triple the rate before the pandemic. Of those hardship withdrawals, 36% were to avoid foreclosure or eviction. 31% were to cover medical expenses. 13% were to pay for tuition. Same economy. Same record high on paper. Completely different experience depending on where you are standing inside it. So the real question is not whether the economy is booming. By certain measures it genuinely is. The real question is who the boom is actually happening to. Because the trillions of dollars generated when asset prices climb do not fall on the country like rain. They land in specific accounts belonging to specific people. And if you do not own those accounts, the record highs are not really happening to you. They are a headline you scroll past on the way to work. Follow the paper trail and the picture becomes impossible to ignore. There are approximately 134 million households in America. According to the Federal Reserve's own data, the wealthiest 1% of those households, roughly 1.3 million families, own more than half of all the stocks in the country. Zoom out to the top 10% of wealthiest households, about 13 million families, and they own approximately 87% of all stocks. Which means the bottom 90% of the country, around 120 million households, collectively own just 13% of the stock market between all of them. Go further down and the picture sharpens. The bottom half of Americans, 6 to 7 million households, the teachers, the nurses, the bus drivers, the people running the actual day-to-day of this country, own approximately 1% of the stock market. Not 1% each. 1% total, divided among 6 to 7 million households. The typical response to this is that almost everyone owns some stocks now. And there is some truth there. About 58% of Americans hold stock in some form, usually through a 401k. But owning some stocks and owning enough to matter are two completely different things. For the bottom half of the country, the median stock holding is around $13,000. For the top 10%, that number is approximately $600,000. A 48-fold difference. When you put actual dollar figures to what a year like 2025 means for each group, the scale becomes hard to look at. The market returned approximately 16%. For the bottom half, that translates to a paper gain of around $2,000. For the top 10%, the same 16% return handed them roughly $96,000. Same market. Same percentage. Two completely different worlds. And this is just 1 year. The market has risen over 120% since 2020. Now forget the charts for a moment and go to ground level, because the story you keep hearing is simple. The consumer is strong. Spending is holding up. The economy is fine. On the surface that can appear true. But the truth about the average American consumer is not in the headline. It is in their wallet. Start with income. Last month average hourly earnings were up about 3.6% from a year earlier. That sounds like a raise. Except over that same period, inflation ran at 3.8%. The raise got eaten by inflation before it ever landed. So before the average American spends a single dollar, they are already losing ground. Gallup asked Americans to name the single biggest financial problem facing their family. The top answer was not unemployment. It was not low wages. It was the cost of living. 31% of Americans named high costs and inflation as their most important financial problem, near the highest level in the more than 20 years Gallup has tracked this question. Prices are up over 28% since the start of 2020. 55% of Americans say their financial situation is getting worse. So if finances look this stretched, how is consumer spending still going up? The answer is that the spending is being borrowed from the future. Americans are now carrying approximately $1.25 trillion in credit card debt at an average interest rate of around 23%. And this is not the wealthy optimizing points or chasing airport lounge access. Among people carrying credit card debt, Bankrate found that 33% cite covering day-to-day expenses as the primary driver. They are not financing a vacation. They are financing their survival. There is a term for this now: survival debt. And 61% of people with credit card debt have been carrying it for at least a year, an 8-point increase since 2024. Once this kind of debt takes hold, there is rarely a clean way out. And it does not stop at credit cards. Buy now, pay later financing, which used to be for furniture and concert tickets, now has more than 90 million users in America. According to LendingTree, more than a quarter of buy now, pay later users have used it for groceries. More than half say they could not make ends meet without it. A significant portion of this country is now financing the grocery run just to get through the week. Then there is the final number that ties it all together. The personal savings rate has dropped to approximately 2.6%, near its lowest level ever recorded, down from 5.5% just a year ago. And economists at the Bureau of Labor Statistics and the Bureau of Economic Analysis ran the numbers across the income distribution and found something that should stop everyone cold. For the bottom half of the country, more than 65 million households, the savings rate is actually negative. They are spending more than they bring in after taxes every single month. It is not just that the safety net is thin. For half of America, the safety net is gone and the floor is moving further away. That is the divide. And for years economists described it with one shape: the K-shaped economy. Winners rising on the top arm. Everyone else sinking on the bottom one. The gap between them widening. The phrase is the rich get richer and the poor get poorer, drawn as a letter. But the honest shape of what is happening in America right now is not a K anymore. It is an E. 3 horizontal bars representing 3 different classes living 3 completely different economic lives. The top bar is the ownership class. The wealthiest 10% whose wealth lives in stocks and real estate. Home prices up approximately 55% since 2020. Stock market up over 120%. This group has watched their net worth explode because they own the assets being inflated. They pulled away from everyone else not because they worked harder but because they owned more of the things that went up. The bottom bar is sitting near the floor. The 67 million households that own roughly 1% of the stock market. Negative savings rates. Survival debt. Groceries split into 4 payments. They do not own the assets going up. They are just trying to remain solvent through the month. And then the middle bar. Everyone in between. The households whose raises were swallowed by inflation. This bar is tilting downward because something quiet is happening to this group. As Heather Long, chief economist at Navy Federal Credit Union, put it directly, there has been a pronounced shift in spending toward warehouse and discount stores like Costco, Walmart, and Aldi, migrating away from higher-end grocery and retail experiences. This is the class with a thin layer of breathing room remaining, and they can feel it getting thinner. The top 10% of households now hold approximately 68% of the total net worth in the country and just over half of all income. The middle 40% hold around 29% of net worth and earn about a third of income. The bottom half are left with approximately 2.5% of the net worth and roughly 10% of the income, split among 67 million households. And the gap between these groups is not holding steady. It is widening. That is why the news and your bank account never seem to line up. Add up all the wealth, all the market gains, all the numbers going up and to the right, and the result is a booming economy. But what those aggregate charts cannot tell you is who is actually holding any of it. Record stock market highs. Record low consumer sentiment. Same country. 2 completely different Americas running in parallel, and the distance between them growing wider every year.